Socioeconomic score has absolutely no correlation to capital growth. Most investors focus on the wrong data, and this is one of the most overused data factors. It's socioeconomic status, or ERSAD score. It looks impressive, it sounds important, but it means absolutely nothing for capital growth. Now I know that sounds shocking because a lot of gurus and data dashboards, they love to hype it up and talk about it as one of the biggest factors. But if you've been investing long enough, or even just looking at the numbers properly, you will see that socioeconomic data has absolutely nothing to do with what actually drives property prices up. And in this video, I'm going to show you why that is and go through real examples using the data so you can see this for yourself. You're going to see suburbs with low socioeconomic scores that have outperformed the Australian average, and you're going to see suburbs with high socioeconomic scores that have underperformed against the Australian average as well. Socioeconomic score, once again, has zero correlation to capital growth. I really want you guys to understand this. And if you want real growth, you need to stop looking at vanity metrics, and the only things that you need to look at are the three pillars of capital growth, which is low supply, high demand, and ideal market cycle timing. That is it. So let me break it down and show you the actual numbers, because a lot of investors are using socioeconomic data to make decisions, and they're focusing on the completely wrong thing. Now, before I begin, if you're new here, just hit that subscribe button. Let's go. Now, socioeconomic data is actually what I call one of the unimportant factors. There are actually many unimportant factors that I discuss in my private community, and this is one of them. A lot of people waste time on factors that don't actually lead to capital growth. There is no evidence that supports these factors driving price increases, and some of these unimportant factors might actually influence supply and demand, but if it is, then you're going to see that in the data. So there's no point looking at things like socioeconomic status, crime rate, projects are another unimportant factor, because if any of these things are going to influence capital growth, you will see that in the supply and demand. If a suburb is poised for above average capital growth, you're going to see a huge imbalance of supply and demand. Now, a lot of people focus on these because news media uses them for attention. There's property gurus and buyer's agents out there that use them to seem sophisticated. People love overcomplicating things just to make it sound like they're extra smart. But capital growth is very, very simple. As I mentioned, it's just about supply, demand, and market cycle timing. You don't need to focus on anything else. Now, let's firstly talk about a couple of things when it comes to socioeconomic status. So there's obviously going to be high wages or wage growth, and there's going to be things like public housing and crime rate. Now, let's talk about high wages or wage growth first. Now, a lot of people would like to say that gentrification leads to capital growth. An idea that I would like to put out there, and I want you guys to think about, is it's actually capital growth that leads to gentrification. Hear me out here. So people think that if more and more wealthy people move into an area, that's going to push up prices. But what I'm telling you is, when you have a housing shortage and there's more people wanting to live there than there are houses available to buy, there's an imbalance of supply and demand. Now, when the market cycle timing is also ideal, which means that it hasn't grown an extraordinary amount over the last 3 to 5 years, that market sentiment is also primed for above average capital growth over the next 3, 4, 5 years and maybe beyond. Because if the area hasn't grown too much, there's that market sentiment like, oh look, this area's been quiet for so long, and people can psychologically accept the fact that prices will increase in the coming years. But if an area has already grown 100 or 200% in the last 5 or 6 years, then even if supply and demand is imbalanced, a lot of the times that growth won't be sustainable for a sustained amount of time, like 4 to 5 years, for example. Now, when supply and demand and market cycle timing are imbalanced, you have house prices increasing. When vacancy rates are super tight, so the rental supply is really low, you have rents increasing. Now, as prices increase and rents increase, there is only a certain type of demographic that can afford the new prices. When house prices go from $500,000 to $1 million over the span of 5, 6, 7 years, there's only a certain type of demographic that can afford to buy $1 million properties. When rents increase from $400 a week to $700 a week over the next 6, 7 years, there's only a certain type of demographic that can afford to rent out properties that are costing $700 a week to rent. So naturally, when supply and demand increases prices, you will start to see wealthier individuals move into an area because they're the only type of people that can actually afford that location and the new prices. Now let's go into the data with high wages or wage growth. So this is the 1991 census income versus the 28-year growth. Now, full disclaimer here, this is not my chart. I've actually gotten this from Jeremy Shepherd, who's the founder of DSR Data. He's the king of data. All props to him. I greatly appreciate everything you've done for the data-driven property investing community. He is the OG when it comes to data. So all props to him. This is where I got this from. And I just found it very, very interesting. So I thought I'd share this with you guys. So this is the 1991 census income and then the 28-year growth in accordance with all of the suburb income. So this is the higher socio suburbs. This is the lower socio suburbs. And you can see all across the board, there is very minimal difference between how much house prices have grown over the next 28 years in comparison to all the average income levels of the different suburbs all across the country. And that's why I say men lie, women lie, but the data doesn't, because the data is clearly showing you there is negligible difference when it comes to higher socio suburbs, lower socio suburbs, and capital growth. Because capital growth is all about supply, demand, and market cycle timing. It doesn't care about crime rate. It doesn't care about how rich or how poor a suburb is. It just cares about supply and demand. And if anything, it's actually the middle class that actually performed the best. But it is so negligible in terms of the difference that it's not even worth noting that. You got, maybe 7%, 7.1% per annum growth, whereas everywhere else is around maybe 6.8%. Not much difference at all. So there's no real difference when it comes to incomes and capital growth. But this is looking at suburbs and seeing how much they've grown over the next 5 years in comparison to the suburbs that have had the highest income increases and the suburbs that have had the lowest amount of income increases in that suburb. So you got the lowest amount here, highest amount here, barely any difference between the two. And look, once again, this is over a 5-year time span. So what I would say is if you kind of extrapolate this out over 10, 20, 30, 40 years, you'll see this even out even more. Once again, you can kind of see the middle portion actually seems to be doing the best. But as I mentioned, look, if you expand this over 20, 30, 40 years, I guarantee you're going to see a much more even capital growth rate. So once again, there's no real correlation when it comes to income increases or gentrification, etc., and capital growth. Now let's talk about crime rate and public housing. So do high crime rates and public housing affect capital growth? No, they do not. There is absolutely no direct correlation between crime rates, public housing, and capital growth. You have to remember when you're buying property, you're buying one property, and you're not buying the entire suburb. Now, the pockets of the suburb also matter because every suburb has better and worse pockets. And if you want to minimize your risk when it comes to tenant quality, etc., you do want to target the slightly better pockets within the suburb. But that doesn't mean that the public housing pockets aren't going to grow as well. When a suburb grows, everything grows. You just minimize your risk from that tenant perspective when you do target better pockets. And generally, it is a little bit more desirable, so you do have the chance of selling properties in those more better pockets of lower socio suburbs for a bit more of a premium price, maybe to an owner-occupier, just because they're in a better pocket. But if, let's say you're buying in a public housing pocket and you get the property at an insanely low price, it could still be worth considering, because a thing that is important to note, and take this with a grain of salt, is that there is no bad properties, only bad prices. Because if the property is discounted enough, even if it has some red flags like being in a public housing pocket where 30 or 40% of the houses are public housing, but you're getting it for $150,000 below market value, that's $150,000 you've made from day one, right? So, but yeah, take that with a grain of salt. But what I'm saying is, you're only buying one property, not the entire suburb. Now, here are some real examples of high growth, rough suburbs. Like during the Sydney boom previously, when Sydney grew around 80% overall, Mount Druitt, which is a low socioeconomic area, grew 110%. Now, even a more recent example like Perth in the early 2020s when it started its boom, Armidale, known as the meth capital of Perth by the locals, was one of the best performing suburbs. Now let's check out the data of these suburbs and even some more suburbs, and I'll discuss a high socio suburb as well, just so you can see the data in real time. So let's go to Mount Druitt right now. You can see over the last 20, 25 years, when it's had major price increases, you can see it's gone from prices of 640,000 to 950,000 in just a span of 3 years. And if you had some reservations about the area just because it was a bit of a lower socio area, you would have missed out on $100,000 of capital growth per year for 3 years straight. All right, so that's why you don't want to be biased when it comes to property investing. But what I will say is, when you have a budget of right now 1 million or 1.1 million, which is the typical value of Mount Druitt right now, if you have that type of budget, you do have the luxury to maybe look at some other suburbs that are higher socio. And what I'm saying is you just have to see that as a bonus. It's not a must-have, but if you do have the luxury of picking and choosing, that's a bonus. If you do have a lower budget, let's say of $500,000 under, you're not buying in a suburb where there's multi-millionaires living there, right? So you can't be very picky when it comes to choosing suburbs. When you do have that, you're working with that lower price point of $500,000 under. But let's check out the data for Mount Druitt right now. So you got an ERSAT score of 2. So just to give you some context, it's out of 10. So 10 being like the highest socioeconomic suburbs, 1 being the lowest socio suburbs. Number 2 is very, very low. You've got a high percentage of renters in the area. But stock on market is super low, very low building approvals in the area because it is a established suburb, very low inventory. Demand has been picking up over the last 12 months. Now, because I'm seeing supply and demand very imbalanced, so you can see very low stock on market. It's been coming down over the last 12 months. Vacancy rates have remained low over the last 3 years. Days on market has been coming down over the last 3 months. So supply and demand is becoming very imbalanced. It has already grown $250,000 over the last 3 years. And it is, even though it's a low socio suburbs, and some data experts or property gurus will tell you, look, it's already at $1 million. It's got an ERSAT score of 2. Affordability is very, very low. It's at 60, 65 years. It can't continue growing. But because supply and demand is still imbalanced, and the market cycle timing isn't looking too bad because it has slightly underperformed over the last 3 years and over the last decade as well. It has slightly overperformed over the last 5 years, but last 10 and 3 years are looking very good. Now, because of that, and because supply and demand is very imbalanced, you can expect to see continued strong growth in Mount Druitt. And what I suspect will happen is the area will begin to gentrify as house prices go to 1 million, 1.1, 1.2. There's only a certain type of individual that can afford to pay $1.2 million to move into an area, right? So naturally you have wealthy individuals going to move into this suburb and less wealthy individuals move out of the suburb. And when it comes to public housing, as I mentioned, you're only buying one property. So if you look at some of these areas here, this is social housing. You got a pocket here where 25% of the houses are public housing. You got a pocket here where 20% is. But the rest of Mount Druitt, generally there's no public housing all around here, up north, even further down south. A lot of areas and a lot of streets and groups of streets where there's little to absolutely no public housing, which you could target if you are a little bit more risk averse and you do want to stay away from public housing. Now let's talk about a more recent example. During the recent Perth boom, you got Armadale, where if you spoke to locals, they wouldn't touch Armadale with a 10-foot pole. But because they wouldn't do that, they've also missed out on 141% of capital growth over the last 5 years. Now, if you understood supply, demand, and market cycle timing was all that mattered, you would have been investing here in around 2020, 2021, and you would have more than doubled your property's house price. So imagine if you bought 5 of these houses for $300,000, dirt cheap. You could have got over 6, even 7% yield sometimes. You would have had $1.5 million of property that would have grown to over $3 million worth of property, and would have been neutral to positive cash flow as well because of how good the yields were back then. So that's $1.5 million that you could have made just buying properties in this low socio, rough area of Perth called Armadale. It's doubled in value over the last 3 years. And let's have a look at the ERSAT score, a 1 out of 10 ERSAT score. So you got a very low socio suburb. Let's check out the affordability index. Very bad when it comes to, from a data expert point of view. Some of these data experts telling you, oh, look, it needs to be, especially at that price point, needs to be close to 35, 30, if you want to maximize your capital growth. But look how unaffordable the suburb is. And look how low the socioeconomic status is. It's as low as it can get. But if you bought here in 2020, or even if you bought here in 2022, you would have doubled your house's value. If you bought here in 2020, you would have more than doubled your property's value. Your $300,000 property would have grown to over $650,000 to $700,000 already. All right, so that's why I say, especially when you have the lower budgets, you don't want to be too picky. You just want to look at supply, demand, and market cycle timing, the 3 pillars of capital growth. And if you look at the suburb of Armadale, you have a little bit more public housing scattered around than your Mount Druitt's. But once again, you have your rougher pockets and your less rough pockets. So if you did want to be a little bit more risk averse, you can target the pockets where there's zero public housing here, all across here. There's very minimal all over here, just 3%, 5% over here. You could even target this one around 11% and maybe just avoid the ones that are 20% and above. So remember, there are markets within markets. There are different pockets of each suburb, and you're not buying the entire suburb. You're buying one property on one street within that suburb. Now, let me talk about an example of a property that I actually just sold last year, which was in Townsville. So a lot of people made a lot of money during the Townsville boom, including myself and my clients. And a lot of these Townsville suburbs were very low socio. When I started buying here, so I bought in this suburb called Condon, around the time when the typical value was around like 320,000, I believe it was. It was around here. Right, it hadn't grown for like a decade straight. I bought it around here. I saw at the very bottom of the market, and I saw that supply, demand, and market cycle timing was just lining up perfectly. It's a low social area, just like a lot of parts of Townsville, actually. A lot of people were telling me, don't buy here. Why would you buy in Townsville? There's a lot of public housing, a lot of crime, a lot of floods. So it's a very risky area to buy. But I bought in Townsville many properties for my clients, for myself, and we've done quite well. You can see the suburb has pretty much doubled in value in the last 3 years, despite being a low social suburb, just because supply, demand, and market cycle timing. Let's check out the ERSAT score for Condon, 2 out of 10. So very low socio type of suburb. Affordability isn't that amazing for that price point at 40 years. And if you look at the pocket of the suburb, you have some pockets here where there is a higher density of public housing, 18% here. This is the roughest part of Condon, 36% here. My property was actually just above the roughest part in a pocket of the suburb where there's nearly 12% public housing. A lot of people would have just ran away. So I bought a property here in Jabiru Avenue, 12% public housing in the area. I bought that property for $320,000. I sold it for 50% more than what I bought it for just about 15 months later. So 1 year, pretty much 50% capital growth, right? Which is, once again, I want to really reiterate the point here. Supply, demand, and market cycle timing is all that matters. It does not, capital growth does not care about your feelings towards what is the demographic of the area, or would I like to live here or not. Would I live in Condon? I definitely would not live in Condon. It's just not for me. Nothing against Condon, nothing against Townsville. I'd love to actually visit there sometime. I've personally never been there, despite buying many properties there. But would love to visit. Probably wouldn't like to live, just my personal preference. I love living in Melbourne. But during that time, I wasn't buying in Melbourne. I was buying all over Queensland, WA, South Australia. And now that brings me to my next point. Let's talk about a higher socio suburb in Melbourne, for example. So this year I've been talking a lot about Melbourne and towards the end of last year. But just because I live in Melbourne and I love living in Melbourne, I'm not biased towards Melbourne, because since 2022, Melbourne has not grown for about 3 years straight, right? From 2022 to 2025, absolutely no growth. From 2025 onwards, if you invested in the right suburbs, you would have probably been $150,000 up by now already. So market cycle timing is everything. But if you were speaking to me in 2022, 2023, and I was buying in places like Townsville, for example, I would tell you, don't go near Melbourne, right? I wasn't buying in Melbourne for myself. But now this year, I am buying in Melbourne. Now this is a high social suburb of Melbourne, which right now is actually looking very, very good. Upper Ferntree Gully in the Yarra Ranges Shire. Look, let's say it's just in the eastern suburbs of Melbourne. You get a very high socioeconomic score, 8 out of 10 ERSAT score. It's underperformed over the last 3 years, underperformed over the last 5, 7, and 10 years as well. So if you bought here 5 years ago, you would have made 31 to 32% of capital growth. If you bought in Condon 5 years ago, you would have made 130% capital growth. If you bought in a lower socio suburb like Armadale 5 years ago, you would have made 140% capital growth. Now imagine buying multiple properties here during these times in these lower socio suburbs when you could have made heaps of capital growth Now Melbourne's starting to look good, and the higher social suburbs in Melbourne are starting to look good as well. Even though they've underperformed over the last decade, the next decade is looking very different. And you could have sold all these properties that you've already doubled your value in, and now started entering these higher social suburbs. But look, my main point is high social suburb like Ferntree Gully is still underperformed, not just over the last 3 years, but 5, 7, and 10 years. As I mentioned, the next 3 to 5 years are looking very different in my opinion. I expect to see above average capital growth for the suburb, but I would not have bought here 3 to 5 years ago. Unlike these other lower social areas in Perth, in Brisbane, regional Queensland, regional WA, for example, where it was a perfect timing to buy. So market cycle timing, supply and demand is everything. That's how you maximize your capital growth. You need to follow the 3 pillars of capital growth. Everything else is just a bonus. And you need to be realistic with your budget. As I mentioned earlier, for lower budgets, you generally can't escape lower social suburbs. If you've got a budget of $400,000 to $500,000 and you're looking to buy a freestanding house in a high growth location across the country, you're not going to be buying in a suburb where your neighbors are all millionaires, right? So you need to be realistic. But if you have a higher budget of, let's say, $1 million and you can afford to buy in suburbs like Upper Ferntree Gully, then yes, I would rather buy in Upper Ferntree Gully than buy in Mount Druitt, for example, right? Because you have that luxury of choosing many suburbs in your budget that are actually high socio. But just remember that this is a bonus and it's just a luxury, right? But it doesn't mean anything when it comes to capital growth, because supply, demand, and market cycle timing, if these 3 things are lining up, you will get above average capital growth. If you like this sort of thing and you actually want to learn how to maximize your capital growth the right way, check out Simple Capital Academy. It's my private community where you will learn the entire property trading system from start to finish. This is exactly how you maximize your capital growth through property investing. You can check out my suburb watch list every quarter. You can check out and join my live coffee Q&A sessions where you can ask me anything, and you'll have everything you need to become a confident investor. And if you would rather a done-for-you service, you can check out Simple Capital Advisory. This is where I help you secure an A-grade property and guarantee you above average capital growth. Guaranteed. If that is something you want, just book a call using the link below. Thanks for watching, have an amazing day, and I will see you in the next one.